Hey everyone, welcome back to Corporate Decoder, the place where we untangle the corporate world. And today we're diving deep into Columbia Fund's Series Trust IICE latest filing, where it looks like they are managing quite a few funds, and we have an opportunity to peek behind the curtain at their financial strategies and holdings. Think of this as a financial checkup for a whole family of investment portfolios. We are going to explore how these different funds performed over the reporting period and what their investment strategies look like right now. Before we jump in, if you enjoy getting clear, straightforward insights from these often complex corporate documents, do us a huge favor and hit that subscribe button. And hey, we've built a fantastic community over on Discord where we break down these filings in real time, so check out the link in the description below to join us there. Alright, let's get straight to what the filing is all about. This is a certified shareholder report for Columbia Fund's Series Trust III. The report covers the period ending the 31st of July 2025. Essentially, it's a window into how several Columbia capital allocation portfolios have been doing. We are looking at a few different portfolios here, starting with the Columbia Capital Allocation Conservative portfolio. For a hypothetical $10,000 investment in class, shares for the reporting period, the cost came out to about $27, which is 0.54%, and for Class C shares it was $65 or 1.29%. This gives you a quick snapshot of the direct costs associated with these investments, showing that different classes do have different cost structures. When we look at key fund statistics for the conservative portfolio, the fund net assets are substantial at $150,003,740. They hold 37 portfolio holdings, and the portfolio turnover for the reporting period was a low 3%. This low turnover suggests a more stable buy and hold strategy, which is often aligned with a more conservative approach. Now let's talk about where the money is actually invested. The top holdings for the conservative portfolio, the largest holding at 19.6% is the Columbia Bond Fund Institutional 3 class. This is followed by the Columbia US Treasury Index Fund Institutional 3 class at 14.1% and the Columbia Quality Income Fund Institutional 3 class at 13.8%. This heavy weighting in bond funds clearly signals the conservative nature of this portfolio aiming for stability and income. Diving into the portfolio of investments for the Columbia Capital Allocation Conservative portfolio, we can see the breakdown under investments in securities. Equity funds make up 20.2%. For example, they have 591,007 shares of Columbia Overseas Core Fund Institutional 3 class, valued at $7,186,649. Then we shift to fixed income funds, which are a much larger piece of the pie at 68.5%. This includes holdings like the Columbia High Yield Bond Fund Institutional 3 class at 7.4% and significant amounts in investment grade bonds like the Columbia Bond Fund Institutional 3 class valued at $29,362,338. Finally, money market funds represent 10.7%. This confirms the strategy focuses heavily on fixed income to manage risk. Now, they also detail their fair value measurements. This tells us how they value these investments. Level 1 valuations come from quoted prices in active markets, Level 2 from other observable inputs like interest rates, and Level 3 from unobservable inputs where the fund's own assumptions are used. For this conservative portfolio, the vast majority, $149,162,458 of investments in securities are in Level 1, meaning they are valued based on readily available market prices. The derivative instruments like forward foreign currency contracts are primarily Level 2, valued using observable market data, showing a commitment to transparent valuation methods. Moving on to the Columbia Capital Allocation Moderate portfolio, the story is a bit different. For class of shares, the cost of a $10,000 investment was around $19 or 0.38%. This suggests a lower expense ratio for this class compared to the conservative portfolio's class as shares, which were $27. The fund net assets for the moderate portfolio are significantly larger at $1,031,387,113. Looking at the top holdings for the moderate portfolio, we see a more balanced approach. The Columbia Bond Fund Institutional 3 class is still present at 11.9%, but it shares the spotlight with equity. Focus funds like Columbia Overseas Core Fund Institutional 3 class at 10.8% and Columbia High Yield Bond Fund Institutional 3 class at 10.5%. Notably, Columbia Large Cap Growth Fund Institutional 3 Class and Columbia Select Large Cap Equity Fund Institutional 3 Class are also in the top holdings, indicating a greater tilt towards growth and large cap equities. The portfolio of investments breakdown really highlights this strategic shift. Here, equity funds represent a much larger 50.1% of the portfolio compared to just over 20% in the conservative fund. We see significant holdings in international equities like Columbia Emerging Markets Fund Institutional 3 Class and Columbia Overseas Core Fund Institutional 3 Class. US large cap equities also make up a substantial 35.3%. Fixed income funds, while still a significant piece at 47.7%, are a smaller proportion than in the conservative fund. Money market funds are a smaller 1.4%. This allocation clearly demonstrates a moderate risk profile, seeking growth from equities while maintaining a substantial allocation to fixed income for stability. Similar to the conservative portfolio, the majority of the moderate portfolio's investments in securities, a massive $1,023,205,624, are in level 1 valuations, meaning they are based on quoted prices in active markets. The assets are valued using the market approach, valuing securities through reference to prices and information from market transactions for similar or identical assets. This focus on observable inputs suggests a sound valuation process. Now for the risk takers, the Columbia Capital Allocation Aggressive Portfolio. For Class A shares, the cost on a $10,000 investment was $19 or 0.38%. Similar to the moderate portfolio's Class A, the fund net assets are the largest we've seen so far at $1,337,862,076. In the aggressive portfolio, S-top holdings, equity funds dominate. The Columbia Contrarian Core Fund Institutional 3 Class leads at 15.2%, followed closely by Columbia Select Large Cap Equity Fund Institutional 3 Class at 14.9%, and Columbia Large Cap Growth Fund Institutional 3 Class at 14.4%. This is a clear indicator of an aggressive growth strategy, with a strong emphasis on large cap US equities and international emerging markets. Fixed income is a much smaller portion here, only 17.5%. The portfolio of investments for the aggressive portfolio shows equity funds forming a commanding 80.6% of the holdings. International equity funds like Columbia Emerging Markets Fund Institutional 3 Class and Columbia Overseas Core Fund Institutional 3 Class make up 20.2%. US large cap equities are a significant 57.2%. Fixed income funds are a reduced 17.5%. This aggressive allocation is designed to maximize potential growth by taking on higher equity market risk. This aggressive portfolio also relies heavily on level 1. $1,078,785,508, and level 2 $614,419 for forward foreign currency exchange contracts valuations. The use of observable inputs for the vast majority of its assets, including its significant derivative positions, suggests a robust approach to assessing value, even within a riskier investment profile. The fact that the bulk of their investments are level 1 means they are primarily valued using quoted prices in active markets, which is generally seen as a good thing for transparency and accuracy. Looking at the statement of operations for the Columbia Capital Allocation Conservative Portfolio, we see that for the 6 months ending the 31st of July 2025, they had a net realized gain or loss on investments from affiliated issuers of negative $1,202,936. This means they actually lost money on investments in their own affiliated funds during this period. This is an interesting point for a conservative fund if we consider the main goal is limiting loss. Interestingly, for the moderate portfolio, the same metric shows a positive $4,126,722. This is a significant difference and highlights how the different asset allocations in each portfolio directly impact their performance, even when investing in the same affiliated funds. The aggressive allocation in the moderate portfolio definitely made a lot of money on their affiliated investments. And for the aggressive portfolio, this number jumps significantly to $19,511,917. This aligns with the aggressive strategy, investing heavily in equities, which likely performed well during this period, leading to substantial gains even from affiliated funds. Now, let's check out the financial highlights for the conservative portfolio, Class A shares. The total return for the 6 months ending the 31st of July, 2025 was 4.16%. For the moderate portfolio, Class A shares saw a total return of 5.74%, and the aggressive portfolio, Class A shares, achieved a total return of 6.70%. This clearly shows the aggressive strategy, as expected, aiming for higher returns. Looking at the expense ratios, the conservative portfolio Class A has a net expense ratio of 0.54%, the moderate portfolio Class A is 0.38%, and the aggressive portfolio Class A is 0.38%. It is good to see that the more aggressive portfolios, which are expected to take on more risk, are not necessarily more expensive to hold. In fact, the expense ratios for the aggressive and moderate portfolios are the same for Class A shares. Finally, let's look at the net assets at the end of the period. The conservative portfolio is at $129,335,000. The moderate portfolio is at a whopping $942,430,000, and the aggressive portfolio is at $1,154,529,000. The sheer size of the aggressive portfolio in terms of net assets suggests that investors are choosing to allocate more capital to the higher, return-seeking strategy, at least within this group. Okay, let's put our Warren Buffett hat on for a moment and analyze what this all means. The conservative portfolio is doing exactly what its name suggests, leaning heavily on bonds for stability. The moderate portfolio strikes a balance, seeking growth from equities, but still keeping a solid footing in fixed income. And the aggressive portfolio is going for broke, putting most of its chips on equities for maximum growth potential. The fact that the aggressive portfolio has the largest net assets implies investors are either more comfortable with risk or are seeking higher growth, which is a common trend when markets are perceived to be favorable. However, the real tell will be how these allocations perform in different market conditions, especially if we see a downturn. The bond holdings in the conservative and moderate portfolio should offer some cushion. The strategy for the aggressive portfolio, heavily weighted in equities, will be tested in any market volatility. The consistently lower expense ratios across the different classes, especially for the institutional and aggressive moderate classes, is a big positive and aligns with seeking efficient growth. What stands out is how transparently they break down their derivative usage and fair value measurements. The fact that the majority of their investments are valued at level 1 in active markets is a sign of good valuation practices, especially for the larger portfolios. The notes to financial statements are quite extensive, detailing their affiliate transactions and risk management, for instance, their use of derivatives like forward foreign currency exchange contracts, futures, and swap contracts. The notes on offsetting assets and liabilities in derivative transactions are crucial for understanding the potential counterparty risk, and it is good to see they are actively managing this through agreements like ISDA-master agreements and collateral. Their line of credit facility being unused indicates sound financial management, not needing to resort to short-term borrowing for liquidity. Here is the thing though, while the aggressive strategy aims for high returns, it comes with higher risk. The filings show significant allocations to equities, and even some emerging market exposure which can be volatile. While the top holdings are dominated by affiliated funds which might seem like an internal shuffle, it is a common practice for fund families to utilize their own products. The key is that these underlying funds are performing well, and the numbers here suggest they are for the most part. The strong performance across the board, especially in the aggressive and moderate portfolios, indicates effective management in the current market environment. However, an economic downturn could quickly change this narrative. Investors in the aggressive portfolio should be prepared for more swings in value. Overall, Columbia Fund Series Trust Dessous seems to be managing a diverse set of funds with clear strategies aligned to their risk profiles. The financial health looks solid across the board, marked by strong net assets and reasonable expense controls. The key takeaway here is that the alignment of investment strategy with risk tolerance is evident, but investors should always remember that past performance is not a guarantee of future results, especially in the more aggressive allocations. Alright, that's our deep dive into Columbia Fund Series Trust IS latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.